Hello friends, welcome to Learn Easy. We will discuss money market in financial market. First, let us see what is financial market. Financial market is a market that creates and exchanges financial assets. A market that serves as a link between the savers and borrowers by transferring the capital or money from those who have a surplus amount of money to those who need money or investment is known as financial market. The investors are known as the surplus unit and the business enterprises are known as the deficit units. Hence, a financial market acts as a link between surplus units and deficit units and brings the borrowers and lenders together. One can allocate funds with the help of the following two main ways: through banks and through financial markets. The households who are the surplus units may keep their savings in banks or they may use the amount for buying securities from the financial markets. The financial market and the banks then lend the funds to the business firms who are the deficit units. Financial markets are classified into two broad categories, namely capital market consisting of primary market and secondary market, and money market, which are call money, treasury bills, commercial paper and certificate of deposits. If you find the topic interesting and helpful, do subscribe my channel and press the notification bell. Now, capital market. In one side, Indian household has small savings. On other side, corporates need funds to meet their capital requirements. If an Indian household wants to invest in business, it can be done through the security market by buying stocks, bonds from the capital market, that is, stock market. Capital market has further two branchings. Primary market. The market is also called the new issue market. Company raises capital here to fund its business activity. In the primary market, companies issue their securities for the first time to public in form of shares or bonds. It is here where the IPOs are issued by companies. B. Secondary market. Households who have bought the security in primary market can sell, that is, exit it in secondary market. Here, the already issued securities are traded between buyers and sellers, independent of the issuer's interventions. If the issuer, that is company, wants to buy back its shares, they have to do it in secondary market. Now, money market. Money market is a type of market which trade in such securities which has a short maturity period less than 1 year. Such securities are often risk-free. As the maturity periods are smaller, that is more liquid, and the risk of small, that is volatility, is also smaller, hence their yield is also less. We generally invest in money market through money market mutual funds. Some of the features of money market are: first, it is a market for the short term. Second, there is no fixed geographical location of a money market. Third, some of the common instruments of the money market are call money, commercial bills, certificates of deposits, etc. Fourth, some of the major institutions involved in the money market are LIC, GIC, RBI, commercial banks, etc. So, some of the instruments of money markets are: first, call money. The money borrowed or lent on demand for a short period of time, generally 1 day, is known as call money. The term of the call money does not include Sundays and other holidays. It is used mostly by banks. It means that when one bank faces a temporary shortage of cash, then the bank with surplus cash lends the former bank with money for 1 or 2 days. It is also known as interbank call money market. Second, treasury bills, T-bills. On behalf of the Government of India, treasury bills are issued by the Reserve Bank of India (RBI). With the help of T-bills, the Government of India can get short-term borrowings as they are sold to the general public and banks. The treasury bills are freely transferable and negotiable instruments and are issued at a discount. As treasury bills are issued by the Reserve Bank of India, they are considered the safest investments. The maturity period of the treasury bills varies from 14 days to 364 days. Third, commercial bills. Commercial bills are known as trade bills or accommodation bills. These are the bills drawn by one organization to another. Commercial bills are the common instruments of money market which are used in credit sales and purchases. The maturity period of commercial bills is for short term, generally of 90 days. However, one can get the commercial bills discounted with the bank before the maturity period. The trade bills are negotiable and easily transferable instruments. Fourth, commercial paper. An unsecured promissory note issued by private or public sector companies with a fixed maturity period varying from 15 days to 1 year is known as commercial paper. It was for the first time introduced in India in 1990. As the instrument is unsecured, it can be issued by the companies with creditworthiness and good reputation. The main investors of commercial papers are commercial banks and mutual funds. Fifth, certificate of deposits. A time deposit that can be sold in the secondary market is known as certificate of deposits, CD. It can be issued by a bank only. A certificate of deposit is a negotiable and easily transferable instrument. The banks issue the certificate of deposit against the deposit kept by the institutions or companies. The time period of certificate of deposits ranges from 91 days to 1 year. The CDs can be issued to companies, corporations and individuals during a period of tight liquidity. To conclude, a major platform in financial market where securities and financial instruments with short-term maturities are traded is called the money market. Financial assets like treasury bills, commercial paper and certificate of deposits are some of the short-term debt securities traded in the money market. That's all. Thank you for watching the video.